So contrary to some discussion that's going around regarding interest rates, the Fed does not appear to be backing down from their position of keeping them at status quo or even raising them in 2023. We're going to talk about that in greater detail. Plus, guess what? Seller concessions happening and mortgage buy downs are going on. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today is January the 10th, 2023. Time does fly. So as I mentioned, guess what? A lot of discussion. I've been looking at different reports and just hearing from people back and forth. So basically, the Fed in their December meeting they have all the time, FOMC, basically we're saying that no Fed officials see a rate cut in 2023. And there's no discussion about the magnitude of a rate hike in February. So there is discussion points, and there's blogs and stuff out there. People are saying, yeah, expectations that the Fed will start to ease or even reduce some rates going forward in 2023. But there's no evidence of that. And as I mentioned, it's even the contrary. They're saying, no, we're going to continue to sort of work through that. So ultimately, basically, again, the minutes did reveal participants were worried that an unwarranted easing in financial conditions would complicate their effort to restore price stability, while several noted that the median view on the dot plot that tracked notably above market expectations underscores the Fed's commitment to return inflation to target. So basically, they're not moving on this, okay? So as much as people, economists, analysts, housing people, whatever, would like to see some rate decreases and think we need that to jumpstart our housing market again, I don't think it's going to happen. These guys are pretty resolved as to where they're at. And again, this is not just me talking about this. We have a gentleman here. He's Kashkari, I guess is the guy's last name. And basically, he's saying that he believes the Fed will continue to raise, but pause at 5.4%. We won't know if it's high enough to bring inflation back down to 2% in a reasonable period of time. Any sign of slow progress that keeps inflation elevated for longer will warrant, in my view, taking the policy rate potentially much higher. So again, we've got members of the Federal Reserve saying we don't see us stopping what we're doing, and that's obviously going to continue to affect the housing market as 2023 goes on, which you shouldn't be surprised at this. And again, this is obviously some analysts talking about this on Twitter. Kashkari, who is one of the Fed guys, it will be appropriate to continue to raise rates at least at the next few meetings until we are confident inflation has peaked. As I said, any sign of slow progress that keeps inflation elevated will warrant, in my view, taking the policy rate potentially much higher. Basically, Kashkari's essays offer a framework for thinking about why the Fed and other forecasters whiff so badly on inflation. He says economists need to come up with better ways to diagnose inflation caused by surge price dynamics or factors besides labor and expectations. So yeah, there's always been that discussion point saying that the Fed is either too far behind in their analysis or they're missing what's actually happening in real world or real time. So we'll see if that changes in 2023. But again, no real indication things are going to change here. In the minutes of the latest Federal Reserve Open Market Committee meeting, none of the 19 top Federal Reserve officials expect it will be appropriate to cut interest rates this year. Fed officials welcomed recent inflation data that showed the slowing of the pace of price increases. Furthermore, they stated they wanted to see a lot more evidence of progress to be convinced inflation was on a sustained downward path. 17 of the 19 Fed officials said they expected rates to rise above 5% this year. Officials penciled in the high end of interest rate range at 5.25, with 7 officials penciling in even higher rates. So again, this is what's coming from the entire executive makeup of the Federal Reserve. No one sees interest rates either dropping or reducing. If not, they're going to maintain an even increase this year. So, I think we need to sort of put that to rest and say, what, this is what's actually happening in the marketplace right now. So get used to it. And anyway, folks, if you like the information I provide, if you could help my channel grow and smash that subscribe button, I'd really appreciate that. And if you already are a subscriber, if you could please resubscribe, hit that button again, because I lose subscribers for unknown reasons every day. Again, thank you very much for watching my videos. So going forward here, so we know that the Fed is going to continue with their monetary policy with interest rates. So therefore, that's obviously going to affect homeowners buying property. So if rates are still going up or maintaining, and the world or the housing is unaffordable to the average home buyer, you're going to see price reductions, and you're going to see what? concessions, right? So concessions basically are the seller, the homeowner, is going to give something to the prospective buyer to make the deal happen, to say, I guess you could say, to alleviate some of the pain, to make stuff, to make the transaction go forward. So home sellers get desperate, shower buyers with concessions. Essentially, home sellers are starting to toss in the kitchen sink and more. According to a recent report, 42% of recent sellers have offered at least one concession to buyers, typically in the form of cash credit for things like repairs, mortgage rate buy downs, or closing costs. So yeah, that's what you can actually do. So you may agree upon a price point for your property, but to make it easier or to eliminate all the cash coming at closing from the buyer, things like that, you can roll in a concession. That's up from 31% a year ago and is back to levels seen in July 2020 when the housing boom was taking off. So essentially, the graph there is share of home sales where the seller gave at least one concession to the buyer. You can see that's obviously increased significantly since July 2020. This is in stark contrast to the depths of the pandemic real estate boom when sellers had the upper hand and buyers were going to extreme measures to close deals, paying way over asking and waiving inspections, among other things. So yes, in a seller's market, it got to the point where the buyers were doing the concessions. As I said, waiving inspections, paying way over asking. So great time to be a seller the past couple of years. Not so much now. So now it reverses. So we know that the market's changing just based on small things like this. Now, this is not necessarily small, the grand scheme of things, but from a buyer perspective, it's saving you money. It certainly is quite material. So in stark contrast to the depths of the real estate boom, okay, we say state of play. Concessions were smaller and much less frequent last year, but when mortgage rates started shooting up last fall, sellers grew desperate to attract buyers, and concessions mounted a comeback. Since sellers built up so much equity over the past years, they've been willing to shell out more cash than before the pandemic. So we're going to see, what can that be? You can offer to pay for the repairs, or you could just give them a credit off the purchase price in lieu of the repair dollar values. You can offer to pay for closing costs. I know basically FHA or government-backed mortgages, you can offer 3% or 6% of the purchase price as concessions for the closing costs on the buyer side. So you can actually help them with their bringing their less cash to the table. So essentially, there's things that you can do as a seller to move the property. Obviously, that's more attractive to buyers. And there, if I'm a real estate agent and I have any, how can I put, if I'm worth my weight in my commission, I'm going to be asking all this, if I have a buyer, I'm going to be asking all the sellers and their agents as much as, reduce price, offer concessions. What can we do to make this deal happen, right? Do what you got to do to beat them up. And that's what happens. Again, it's the flip side. A couple of years ago, it was bidding wars and paying 50 grand above asking and no concessions or no waiving stuff on the buyer side. Now we see it's taking form other way around. So now that's how we know the market's really changing. This is interesting. So we got seller concessions, and now we have mortgage buy downs, and they're saying a worrying new trend for 2023. We can't help but get a sense of deja vu all over again when we read about the latest mortgage industry gimmick. What happens when these buy downs reset at even higher rates? And how does this allow the housing market to correct as Fed Chair Powell wants? Well, again, buying the mortgage rate down is not a new concept. It's actually been used for many, many years. However, like everything, it comes back into play in a much more, I guess we'll call it useful or needed time frame because mortgage rates are hovering at 6.5%, 7%. So mortgage buy down that allows potential homeowners to save money on monthly mortgage payments. National Association of Mortgage Brokers describes a mortgage buy down as a type of financing that provides lower interest rates for at least a few years of the mortgage. They are typically offered by the home seller or builder who contributes to an escrow account that subsidizes the loan during the first few years. So what you're doing is you're actually going to break on those buy down years of mortgage payments because you're being subsidized by a contribution from the seller at closing. That's how that kind of plays out. Now realize that after the buy down period's over, you're going to go back up to whatever mortgage rate you need to be at. So it's not necessarily an option arm. It really is a buy down. It's a little different here. So for example, in a 2-1 buy down, homeowners can save interest rates for the first 2 years of the loan, but will pay the first interest rate at the beginning of the third year. A 3-2-1 buy down operates the same principle, lower payments for the first 3 years and full interest for the fourth year of the mortgage. So I've seen this a lot in the past. It's a way for the consumer to be able to purchase a home they want with increased interest rates would make their mortgage payments way too high. If the buyer is willing to offer the seller more for their home, the seller will sometimes make concessions in the form of a buy down. Hence, the home still has to appraise to the higher amount. So there you go. So again, this is not an option arm. This is basically a little different concept, but still kind of works. Now, obviously, existing home sellers can offer this. We're going to see builders are ahead. They're not limited just by existing home sellers. Builders can do this too. I think we may start to see this more with new construction. Builders are in a better position because they control the cost. So they do actually. They know what their land purchase price is, their labor price, their material price is. They can offer incentives like these buy downs as a way to solidify a homeowner actually purchasing their products. So again, not the same as adjustable rate mortgage or an ARM where the rate is fixed for a set period of time before adjusting to a variable rate. Basically, you know what the rate's going to be, but you're actually getting a reduced rate for the buy down period. So ultimately, everyone seems to be asking for them, and I think real estate agents have been overselling it as well. Okay, of course, hey, agents are going to do what they need to do to earn commission and get their buyers a property. So whatever tool is out there, whatever advantage you can secure for a buyer, why not utilize that? Buyers are looking for some relief with their monthly payments, but they still have to qualify at the higher payment level. So that's the whole thing. In other words, there still is a qualification process, but what it's doing is actually making it a little easier for homeowners the first couple of years with the buy down, maybe making a difference in that deal closing or not. So that's how you kind of play this. If it's opportunistic, you might as well do it if it's available to you. Simple as that, right? So, and they say just like a marriage, mortgage buy downs have their pros and cons. They're just like a marriage, for better or for worse. Buyers can save money on their monthly payments for the first couple of years, but once the discounted rate period ends, their monthly payments could end up higher than what they expect. That could be a problem if their income drops since buying the home. So, and we're at that, what I call that inflection point right now. So if you're playing these financial games, right, so rates could either remain or go higher. You're gambling on something like this, hoping rates are going to come down. But you got to be careful because again, price points could come down as well too. So you could find yourself over leveraged or a bit underwater, depending on how the market plays out. Essentially, by offering credits towards a mortgage buy down, the seller doesn't need to reduce price of the home. The buyer is able to more easily afford the payments for the next few years. So it's a way of doing a concession, but not necessarily reducing your price point. So you still get your money, but you've sort of subsidized in a roundabout way the mortgage opportunity for the new buyer. So, I mean, I guess it all comes out in the wash anyway, but just it's the perspective here. Buyers are basically paying attention to the dollar amount of payments. The biggest concern is this house affordable for me? And if not, they won't make the move. So you're right. In this day and age, you got to make the right decision at the right time. You got to take a look at the rates, where the rates are going. You got to take a look at the market, where the market's headed, everything else that's out there. So not easy to be a buyer, but we're seeing some changes now. And I can tell you that this new year already, we're, the weekend of January, I've seen a big change in a lot of the distressed property, a lot of the activity that's going on. A lot more homeowners now going, okay, I've had my American Thanksgiving to New Year's Day sort of time off to not think about my problems and things like that. Now I need to take care of my situation and try to figure things out. So more and more homeowners are actually realizing that, hey, things are changing, and I'm not going to have a big wheelbarrow full of money dropped off by an investor waiting for me at my front door. The market's changing significantly. So what to look forward to for this year? Distressed property opportunities. Obviously, I'm going to show this slide quite a bit because this is what's going on out there. So this is stuff that we get involved in. And I'm going to tell you right now, as I said, already the first real working week of January, there's been a ton of leads that have come in, all from people who are now facing foreclosure, or they're in that process. They know they need to sell. Now they're seeking assistance, wanting some help, and we're starting to engage a lot more people. We were doing it before. Now I see a trend increasing and the opportunity picking up. So obviously, what can you do in the future? You can buy at the foreclosure auction if you want to. There's risks associated with that. You can go after bank-owned, people that like homes that have already been taken back by the lender. They're called real estate owned, REO. Sometimes they're going to be in the MLS as an active sale. A lot of times they're going to be on third-party websites, which means you're going to have to go through a secondary auction, usually a reserve bid auction as well too. Do a short sale. We're going to see short sales coming back into vogue very soon. Short payoff. Obviously, a short payoff is like a short sale with some different twist to it. So those are opportunities as well too. Taking the property over subject to a mortgage. This is going to be a big thing for the future because there's lots of low FHA, 2.5%, 3% interest rates out there. If you can pick it up at the right time with the homeowner not being too far in distress, you could actually manage to take it over subject to the mortgage and actually have a nice mortgage that you're not even on the hook for personally. You're going to see a lot more homeowner association, so HOA and condo association foreclosures going on, especially in various parts of the country that have more than their fair share of HOAs and COAs. We're going to see a lot more probate / estate foreclosures. That's picking up again. And as a result, whenever I didn't even mention tax liens here, clearly with I should amend the slide, but clearly with the increase in property values over the past couple of years, the local counties, the local taxing authorities will probably amend and increase property tax now to reflect what's happened over the past couple of years. So we're going to see, with a poor economy and increased taxes, whatever, some homeowners, for whatever reasons, not paying their property tax, which will create tax liens and tax foreclosures. So I have to add that to the slide. And as a result of the foreclosure process in the end, we have something called the foreclosure surplus, or what's called an overage. So that's actually money that's due to the homeowner if somebody were to buy the property at the auction and not say overpay, but pay more than what was actually owed in the property. That creates that surplus that's the homeowner is actually entitled to, but they never realize it's there, nor do they get communication from the local authorities that something's available. So it's like another niche market is to actually help the homeowners for a fee, of course, go after and provide that information to them and get them hooked up to and share in the revenue. So all this is great opportunity for the upcoming year. And I can say to you that, as I said, we're already 1 week in. I've already seen a major change in what's going on. And to sort of tie that all together, if you want to find out what's happening, like foreclosure auctions, like short sales, like tax liens, and pre-foreclosures, and all sorts of things that are out there, go to gethousingdata.com. That's gethousingdata.com. It's my affiliate link with foreclosure.com, and the reason being because this is all going to be picking up now. This is where you can find the great opportunities to see what's happening in your neighborhood, your neck of the woods. This is the number one provider of distressed property listings in the U.S. So gethousingdata.com. So having said that, hook up with me if you want to know how to do this type of stuff. The reason being, as I said, things are changing, right? I've been busy. I should be putting out more videos. I don't have time for that anymore because I'm actually in the field doing deals, okay? Getting stuff under contract, working with investor buyers, working with people who are having issues with their home. We're doing this out there. So realize I don't just sit here and pontificate and talk about what's going on in the housing market. I'm actually participating in it with real-time awareness and real-time information, so you know what's actually happening in the marketplace. I practice what I preach, everybody. I certainly do. And anyway, so again, new program launching, pre-sales discount, getting before the masses. Guys, the foreclosure market will be picking up. Please remember this. Get involved. Learn it now. It'll be the best opportunity you will have to purchase or acquire property at discount prices. So once again, everybody, thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. And look forward to speaking with you later on this week. Thanks very much.